Most people are going to lose money on their investment this year, not because the market crashes, not because they picked the wrong stock or bought in the wrong neighborhood. They're going to lose because of something nobody warned them about before they put their money in. And here's the thing. These risks aren't hidden. They're hiding in plain sight. In every YouTube video about passive income, every real estate influencer post, every just buy index funds take. The upside gets all the airtime. The risks? They get about 30 seconds at the end, if that. Today, that changes. I'm going to walk you through the risks that actually determine whether you build wealth or quietly bleed money for years. Real estate risks, stock market risks, and one risk that applies to both, that almost nobody talks about, and that one might be the most dangerous of all. Stick with me, because the third one is the one that's already affecting your finances right now, whether you realize it or not. Okay, picture two people. Same age, same income, same city. First, there's Marcus. Marcus is a landlord guy. He talks about equity, cash flow, depreciation at every single gathering. He drives past properties on the way home and does the math in his head. He reads rental forums at midnight. He is certain that owning physical property is the only real path to wealth. Then there's Dana. Dana is index funds all the way. She quotes Warren Buffett, talks about compound interest like it's oxygen, and thinks Marcus is basically paying for a part-time job he calls an investment. She is equally certain that buying, holding, and never touching it is the only intelligent strategy. Here's the uncomfortable truth. They're both right about some things, and they're both dangerously wrong about others. The problem isn't which one they chose. The problem is that neither of them fully understands the risks of their own strategy. They're too busy defending it to ask the harder questions. So let's be honest about both. Starting with real estate, because this is where I see the most dangerous overconfidence. And by the way, one of the risks I'm about to cover in the real estate section has already cost people their entire investment. Not most of it, all of it. Imagine this. You save for 3 years. You scrape together a down payment. You buy a rental property, let's say a 3-bedroom house in a decent neighborhood. You feel like you've finally made a real investment. Something tangible. Something you can point to. Now imagine, 6 months later, the city announces a new highway going up 2 blocks away. Or the largest employer in town starts laying off thousands of workers. Or your area gets hit by flooding, and you find out your standard landlord policy doesn't cover it. This is the part nobody tells you about concentration risk. When you buy a rental property, you're not investing in real estate as a broad market. You're betting everything on one building, on one street, in one zip code. If something goes wrong with that specific location, not the whole market, just that area, your investment takes the full hit. There's no diversification to cushion it. A FEMA study found that in areas hit by natural disasters, property values can drop 15 to 30% overnight, and standard landlord insurance frequently excludes flood, earthquake, and fire damage without specific riders added. One event, one asset, total exposure. Compare that to an index fund. If one company in a 500-company index has a catastrophic year, it barely moves your portfolio. You're spread across thousands of companies. Real estate gives you the power of leverage, but leverage means concentration. And concentration means when something goes wrong, there's nowhere to hide. Here's where it gets dangerous. Stocks have a lot of problems, but they have one massive advantage that real estate investors tend to completely underestimate. You can sell in 30 seconds. Real estate? You're looking at 30 to 90 days minimum to close a sale. Longer if the market is slow, if a buyer backs out, if an inspection uncovers something. And here's what that actually means in a real emergency. Let's say Marcus loses his job, or has a medical bill, or a family situation he didn't see coming. His money is locked in a property he cannot access quickly. And while he's waiting to sell, the mortgage is still due. The insurance is still due. Property taxes are still due. He can't just withdraw $20,000 the way Dana can from her brokerage account on a Wednesday afternoon. According to the National Association of Realtors, The average time to close a home sale is 30 to 60 days in a normal market. And in a slow market, that stretches to 90 days or more. If you've put most of your savings into a property and you need money fast, real estate is one of the worst places to have it. Real estate can build serious wealth, but it is a terrible emergency fund. And people who don't separate those two things often learn the hard way. If you don't have 3 to 6 months of all property expenses sitting in cash before you buy, you are undercapitalized. Full stop. One bad month can cascade into a financial crisis that the spreadsheet math never showed. Stay with me, because the next risk is the one that makes landlords quietly question everything they thought they knew. You've seen the thumbnail. I make $4,000 a month from my rental property. And the number is probably technically true, but it's the number before reality shows up. Standard advice says to budget 1 to 2% of the property's value per year for maintenance. On a $250,000 house, that's $2,500 to $5,000 annually. Some years it's a $200 faucet fix. Other years it's a $7,000 HVAC replacement in the middle of August that your tenant cannot wait on and you cannot postpone. And none of that counts your time. If Marcus is self-managing, screening tenants, handling calls, doing showings, coordinating repairs, research from Rentometer shows that's 5 to 10 hours per month per property. That's 60 to 120 hours a year. If his time is worth even $20 an hour, that's $1,200 to $2,400 in unpaid labor that never shows up in his returns calculation. And then there's the risk that nobody wants to say out loud until it happens to them. In some states, the eviction process takes 3 to 6 months. During that time, zero rent collected, full mortgage still due, legal fees of $1,000 to $3,000, and potential property damage beyond the deposit when the tenant finally leaves. That single event can erase an entire year of profit. Sometimes more. The $4,000 a month thumbnail doesn't include any of that. And the people who invested based on the thumbnail find out about it the expensive way. Okay, switching sides. Because the index fund crowd has real blind spots too, and I'm not going to pretend otherwise. The math on long-term stock investing is genuinely compelling. Historically, the S&P 500 has returned around 10% annually. Compound that over 20 or 30 years, and the numbers are extraordinary. The math works. The problem is the math assumes something almost no one actually does. It assumes you stay invested the whole time. Most people don't. Imagine this. It's March 2020. Dana has been investing for 6 years. She's built up a $150,000 portfolio. She is proud of it. Then, in about 30 days, the market drops 34%. Her portfolio falls to roughly $99,000. She watches $51,000 disappear in a month. And here's what the math doesn't capture. That is not a number on a screen. That is 3 a.m., wide awake, wondering if you made the worst decision of your life. That is the urge, the overwhelming, completely human urge to sell before it gets worse. Delbar's annual research consistently shows the average equity fund investor earns significantly less than the index. In some years, barely half the market's return. Because people buy after rallies and sell during crashes. The market returned roughly 10% historically. The average investor? Closer to 4 to 6% over the same periods. Same market. Completely different behavior. Here's the irony. Real estate investors often handle downturns better. Not because real estate is safer, but because they can't see the price every single day. You don't get an alert saying your house dropped 14% this morning. That psychological distance is actually a feature. This one almost nobody explains, and it's brutal if you're anywhere near retirement age. Here's how it works. Imagine you spend 30 years building a portfolio. You hit your number. You're ready to start drawing it down. And then, right as you begin withdrawing, the market drops 40%. Now you are selling shares at the worst possible prices just to cover your living expenses. And because your portfolio shrank, there's less money left to recover when the market bounces back. A study in the Journal of Financial Planning showed that two retirees with identical average returns over 30 years could have radically different outcomes, purely based on when the bad years hit. Retire into a crash. You could run out of money. Retire into a bull market. You might leave a fortune. Same average return. Completely different life. The order of your returns matters just as much as the returns themselves. And almost no one talks about this until it's too late to fix it. But here's the thing. Both of these stock risks, and all three of the real estate risks, share a common root. And that's what I want to get to now. Because fixing the root fixes everything else. Okay, this is the one. The risk that doesn't show up in any comparison article or investment forum. I call it the information gap risk. Every investment decision you make is built on your understanding of that investment. And here's the uncomfortable truth. Most people's understanding is surface level at best. They know the upside. They've seen it in a thumbnail. They've heard it at a dinner party. But they don't know, in specific concrete terms, how they lose money on it. Marcus bought his rental property based on the gross rent number. He didn't model vacancy, capital expenditures, or his own labor. He wasn't being careless. He just didn't know what he didn't know. And that gap between what he understood and what was actually true, that gap is what cost him. Dana invested in index funds without ever mentally rehearsing a 30% drop. She'd seen the long-term charts. She believed in the strategy. But she'd never actually asked herself, what will I do when this happens? So when it did happen, she reacted with her gut instead of her plan. A 2022 FINRA Investor Education Foundation study found that only 34% of Americans could pass a basic financial literacy quiz covering diversification, inflation, interest rates, and bond pricing. 2/3 of people making real investment decisions have fundamental gaps in their understanding of how those investments actually work. This is the risk that multiplies every other risk. Because when you don't fully understand something, you can't manage it. You can't plan for it. You can't stay calm when it goes sideways. You just react. And reaction is where most wealth gets destroyed. All right, here's how you protect yourself from every single risk I just walked you through. And I want to be specific, because do your research is not advice. Specific is advice. For real estate, before you sign on any property, stress test the numbers at full vacancy for 3 months. Ask yourself this exact question. If my tenant stops paying tomorrow and I can't fill the unit for 90 days, can I cover the mortgage out of pocket without destroying my finances? If the answer is no, you are undercapitalized, and the deal is more dangerous than it looks on paper. Keep a minimum of 3 to 6 months of all property expenses in cash before you buy. That's not optional. That's the foundation. Build 3 scenarios before any real estate purchase. Best case, full occupancy, no surprises. Realistic case, 1 month vacancy. Average maintenance costs. Stress case, 3 months vacancy. 1 major capital expense like a roof or HVAC. If the stress case breaks your finances, the deal isn't ready. You aren't ready. For stocks, write down your investment plan before the market drops. Not during, not after, before. Specifically, write down the answer to this question. If my portfolio drops 40%, what will I do? Write, I will stay invested and keep contributing. Sign it. Put it somewhere you'll actually see it. Because when the drop comes, and it will come, you will be glad you made that decision before your emotions got involved. Set a rule. Automate your contributions so they happen regardless of what the market is doing, and log in no more than once per quarter. The data is clear. The more frequently you check a volatile portfolio, the more likely you are to react to short-term noise. Boredom is an asset. Protect it. And for the information gap risk, here's the one question that filters out almost every bad investment decision before you make it. Can you explain, in plain language, exactly how you lose money on this investment? Not how you make money, how you lose it. Specifically, concretely. If you can't answer that question clearly, you don't understand the investment well enough to own it yet. It sounds simple. It almost never gets done. And it is the single most powerful thing you can do before putting serious money into anything. Here's what I want you to walk away with today. Real estate and stocks are not enemies. They're not competitors. They're tools. And like any tool, they can build something remarkable or cause real damage, entirely depending on whether the person holding them understands what they're working with. Marcus and Dana aren't bad investors because they chose wrong. They're vulnerable because they invested in the upside without fully understanding the downside. And that gap, between what they thought they owned and what they actually owned, that's where most financial damage quietly lives. The investors who actually build long-term wealth aren't necessarily smarter. They're not luckier. They just did one thing. They understood the risks before they felt them. You now know more about the real risks in both real estate and the stock market than most people who've been investing for a decade. That matters. Use it. Right now, before you close this video, think about one investment you hold or are seriously considering, and ask yourself, how do I lose money on this? Can you answer it? Clearly? Specifically? If you can, you're ahead of most people. If you can't, that's exactly where to start. Drop a comment below and tell me, which risk hit you the hardest? The concentration risk? The liquidity trap? The sequence of returns problem, or the information gap? I read every comment, and your answer is going to shape the next video I make. And if this gave you something real, subscribe. Because every video here is built around one idea: the truth about money with nothing left out.